Welcome to the weekly economic focus with me, Isaah Mhlanga, the chief economist here at Alexander Forbes Investments. It has been a busy week in global markets, with some progress on Brexit negotiations following the UK and the European Union's agreement on the draft text of the divorce proceedings last Wednesday, which effectively put the ball on the UK Prime Minister Theresa May's cabinet and parliament. On Thursday, May's cabinet backed the draft agreement. However, there were 6 resignations by British Conservative members of Parliament. After 2 years of difficult negotiations, progress has been made, but the road ahead remains long and difficult, with a divided cabinet, parliament, and country. More pressure remains as prominent Brexit supporters are pushing for a vote of no confidence against Prime Minister Theresa May. The next step is a parliamentary approval, with a key vote likely to take place in early December. It is difficult to call for the outcome at this stage given the cabinet approval was through a narrow majority of 6 members of parliament. UK equities and the pound were down across the board on speculation that Prime Minister Theresa May's government may collapse. The market now tracks the possibility of May's survival, and if she does, the parliamentary ratification process, which at this point remain unclear. The medium-term implications for a good Brexit process will be for a rise in economic growth and a stronger pound, which will be negative for UK equities given that only about 30% of their revenues are derived from within the UK. On the contrary, a protracted Brexit process will lead to increased uncertainty, which will drag economic growth lower, the pound weaker, but with unclear impact on UK equities. Italy's budget resubmission to the European Commission are unlikely to be approved, which will result in greater oversight on Italy's budget and the possibility of sanctions. Meanwhile, Germany's economic growth contracted in third quarter 2018, which is the first time since 2015 as auto exports, its traditional growth engine, was impacted by trade dispute with the United States. In Asia, Japan's economic growth also contracted, while evidence of a slowdown shows up in China. Looked holistically, the contraction in Germany and Japan's economic growth rates and the moderation in China's economic activity all have the common root, the trade tensions with the United States, which mean that more pain from trade tensions will likely come in 2019. More so, surveys in the United States show that US banks will increase borrowing costs if the US yield curve inverts, which seems inevitable if the Fed hikes rates in December and 3 more times in 2019 as shown by its dot plot projections. Of interest locally are developments in oil markets, which so far indicates that we are likely to see an early Christmas gift in the form of a R1.50 cut in petrol prices in December, if the rand and oil price remain relatively unchanged from where they are currently. The biggest contributor to this over-recovery in petrol price is the oil price, which is down about 18% in the past month. The strength of the rand against the US dollar contributes about 12 cents to the potential petrol price cut. This will likely lead to an improvement in CPI inflation outlook, of which the October print is expected to slightly edge up to 5% from 4.9% previously. Given these expectations, we expect the South African Reserve Bank Monetary Policy Committee to keep the repo rate unchanged at 6.5% at this week's meeting. However, the forward rate agreement market still prices in a 60% probability of a 25 basis point hike on November 22. On the economy front, we project that South Africa's technical recession will come to an end in third quarter 2018 as quarterly growth in retail sales, wholesale sales, and manufacturing production offset contraction in mining production. Growth will likely print at 1.5% quarter-on-quarter seasonally adjusted, following a 0.7% and 2.6% contractions in second quarter and first quarter of this year. All around, South Africa is trading places with the global economy, as we have good news for SA and not so good news in global markets. In other news, the Parliamentary Review Committee on Land Reform recommended that Parliament amend the Constitution to explicitly allow for land expropriation without compensation. So far, market response has been muted as this is widely expected after the ruling party, the ANC, announced that decision. That's it for this week, and from me, And all of us here at Alexander Forbes Investments, goodbye and have a great week ahead.